Everyone comes into trading for the same reason, even if they pretend otherwise. They want money. Not just money for survival, but money that represents freedom. Freedom from stress, freedom from bosses, freedom from asking permission, freedom to finally feel ahead instead of behind. That desire feels normal. It feels logical. It feels motivating. And for a short while, it actually is. You open your charts. You watch prices move. You imagine profits hitting your account. You picture a future version of yourself who finally made it. But then something strange happens. The harder you try to make money, the worse your trading becomes. The more you focus on profit, the more mistakes you make. The more you chase money, the faster it runs away. And most traders never understand why. Here is the uncomfortable truth that almost nobody talks about. Trying to make money is one of the fastest ways to lose it in trading. Not because money is bad, not because ambition is wrong, but because the human brain is terrible at decision-making when money becomes the emotional goal. The market does not reward effort. It does not reward desire. It does not reward need. It only rewards execution under uncertainty. And the moment money becomes your primary focus, your mind shifts from execution into survival mode. When money is the goal, every trade starts to feel personal. A winning trade feels like proof that you are smart. A losing trade feels like proof that you are failing. Price movement stops being information and starts feeling like judgment. Your nervous system reacts as if you are being threatened. Your heart rate increases. Your breathing changes. Your ability to think clearly shrinks. You stop following your plan, not because you are careless, but because your brain is trying to protect you from pain. This is not weakness. This is biology. Neuroscience shows that when humans perceive risk to survival, the brain prioritizes speed over accuracy. It favors emotional reactions over rational thinking. This response helped our ancestors survive dangerous environments. But financial markets are not physical threats. Yet your brain treats losing money the same way it would treat losing safety. That is why traders exit too early, hold losers too long, revenge trade, overtrade, and abandon strategies that actually work. They are not stupid. They are reacting exactly how the human nervous system is designed to react under perceived threat. The irony is brutal. The more you need the money, the worse your decision-making becomes. The trader who is desperate to pay bills trades worse than the trader who is calm. The trader who must win trades worse than the trader who accepts uncertainty. The trader who watches profit and loss tick by tick trades worse than the trader who focuses on process. This is why some of the best traders in the world appear emotionally detached, not because they do not care, but because they understand that caring too much about money destroys clarity. Look at how beginners usually approach trading. They open an account. They calculate how much they could make if every trade worked. They imagine doubling their account quickly. They think in terms of outcomes instead of probabilities. Every trade becomes a chance to change their life, and that pressure is unbearable. It creates unrealistic expectations and emotional attachment. The trader starts forcing trades because they feel they should be making money. They enter early. They exit late. They skip stops. They add size. They break rules. And when losses come, they feel shocked and angry, even though losses are part of the game. Professional traders think differently, not because they are smarter, but because they have been conditioned by experience. They know that a single trade means nothing. They know that randomness exists. They know that even perfect setups can lose. Their confidence does not come from predicting outcomes. It comes from trusting a repeatable process over time. Money is the byproduct, not the objective, during execution. This shift sounds small, but it changes everything. There is solid research supporting this. Studies in behavioral finance show that people experience losses more intensely than gains of the same size. This is called loss aversion. In trading, this means fear of losing money is stronger than desire to make it. When money becomes the focus, traders subconsciously avoid actions that feel painful in the short term, even if those actions are correct. They cut winners early because they fear giving back profit. They avoid taking valid trades after a loss because they fear more pain. They hold losers because realizing the loss feels like admitting failure. All of these behaviors come from focusing on money instead of execution. Another well-documented bias is outcome bias. This happens when people judge the quality of a decision based on the result rather than the process. In trading, a bad trade that makes money feels good, and a good trade that loses feels bad. Over time, this destroys discipline. The trader starts repeating bad behavior because it was rewarded once. They abandon good behavior because it was punished by randomness. When money is the focus, learning becomes distorted. Growth stops. There is also the issue of dopamine. Anticipation of profit releases dopamine in the brain. This chemical creates excitement and motivation, but it also creates addiction. Traders who focus on money start chasing emotional highs instead of statistical edges. They feel bored when markets are slow. They feel restless when they are not in a trade. They take low-quality setups just to feel something. This turns trading into gambling, even if the trader believes they are being logical. Trying to make money also creates a time pressure illusion. Traders start thinking they should be profitable quickly. They compare themselves to stories online. They measure progress in weeks instead of years. This leads to impatience. Impatience leads to overtrading. Overtrading leads to higher costs, more errors, and emotional exhaustion. The trader burns out, not because trading is impossible, but because they are sprinting a marathon. Here is something most people do not want to hear. Trading is not about making money. Trading is about managing risk and executing decisions consistently under uncertainty. Money is simply how performance is measured. When you focus on money, you are focusing on something you cannot directly control. You cannot control whether a trade wins or loses. You can only control your entry, exit, size, and behavior. Focusing on what you cannot control creates anxiety. Focusing on what you can control creates stability. Think about athletes. The best performers do not obsess over the scoreboard while playing. They focus on technique, timing, and execution. If a basketball player stared at the score every second, their performance would collapse. Trading is no different. Performance improves when attention is placed on actions, not outcomes. Another reason trying to make money backfires is identity attachment. Traders start tying their self-worth to their account balance. A green day means they feel confident and capable. A red day means they feel stupid and ashamed. This emotional roller coaster is exhausting. It also leads to inconsistent behavior. Confidence after wins leads to overconfidence. Shame after losses leads to hesitation. The trader is no longer stable. They are reactive. Markets exploit emotional instability. When volatility increases, emotions increase. When emotions increase, discipline decreases. This is why markets often move in ways that hurt the largest number of participants. Not because the market is evil, but because collective human behavior creates predictable emotional patterns. Traders who focus on money are more vulnerable to these patterns. There is also the illusion of control. When traders focus on making money, they start believing they can force outcomes. They trade more aggressively after wins. They double down after losses. They believe effort equals reward, but markets do not work like a job. You are not paid for trying harder. You are paid for making correct decisions repeatedly. Effort without discipline is punished. The hardest lesson in trading is accepting uncertainty. You can do everything right and still lose. You can do everything wrong and still win. Trying to make money encourages certainty seeking. Traders want guarantees. They want confirmation. They want to be right. But trading requires comfort with not knowing. The moment you accept that uncertainty is unavoidable, pressure decreases. Decision quality improves. Some of the most successful traders report that their breakthrough came when they stopped caring about individual trades. They stopped watching profit and loss during the trade. They stopped emotionally celebrating wins. They stopped emotionally reacting to losses. They treated trading like data collection. Each trade was simply one event in a large sample. This mindset sounds boring, but boring is profitable. Trying to make money also interferes with patience. Good opportunities are rare. Most market time is noise. When money is the focus, waiting feels like wasting time. The trader feels compelled to act. They confuse activity with productivity. But in trading, doing nothing is often the best decision. Patience is not passive. It is active discipline. Another factor is stress. Chronic stress impairs memory, attention, and impulse control. Traders who constantly worry about money operate under continuous stress. Their sleep suffers. Their mood suffers. Their health suffers. Decision fatigue sets in. They start making careless mistakes. This is why professionals emphasize risk management and position sizing. They design systems that allow them to stay calm. Calm is a competitive advantage. There is a quiet paradox in trading. The traders who make the most money are often the least focused on money during execution. They care deeply about their process. They review trades objectively. They measure performance over long periods. They accept drawdowns as part of the business. They respect risk. Money comes as a consequence, not a chase. This does not mean you should not want money. Wanting financial freedom is normal. The problem is placing that desire inside the moment of execution. Desire belongs in long-term planning, not in trade management. When the trade is on, your job is not to make money. Your job is to follow your rules. A useful mental shift is to think of trading as running a business, not playing a game. A business owner does not expect profit every day. They focus on systems, costs, and consistency. They understand variability. Trading is the same. When you stop trying to win every trade, you give yourself permission to trade well. Many traders ask why discipline is so hard. The answer is simple. Discipline is hard when emotions are high. Emotions are high when money is the focus. Reduce emotional load, and discipline becomes easier. This is why rules, checklists, and automation help. They remove emotion from decision-making. Another overlooked issue is social pressure. Traders compare results. They feel behind. They feel the need to prove something. This adds another layer of emotional weight. Comparison is poison in trading. Everyone has different capital, timelines, and risk tolerance. Focusing on your own process is the only sustainable path. The market does not care about your goals. It does not care about your struggles. It does not care about fairness. It simply reflects collective behavior. When you accept this, resentment disappears. You stop fighting the market. You start working with it. Trying to make money also distorts time perception. Traders want results now. They underestimate how long skill development takes. They quit strategies too early. They constantly switch methods. They never give anything enough time to play out statistically. Consistency requires patience across uncertainty. There is a quiet confidence that comes when you stop trying to force profits. You take trades because they meet criteria, not because you want money. You exit trades because your plan says so, not because you feel fear or greed. You measure success by how well you followed your rules, not by daily profit. This confidence is stable. It does not depend on market mood. Ironically, this is when money starts to appear more consistently, not because you chased it harder, but because you stopped interfering with yourself. You allowed probability to work. You stopped sabotaging edges with emotion. Trading is a mirror. It reflects your relationship with control, patience, fear, and desire. If you bring desperation into the market, you will receive chaos back. If you bring structure and acceptance, you will receive clarity. The goal is not to eliminate emotion. That is impossible. The goal is to prevent emotion from driving decisions. This happens naturally when money is no longer the immediate focus. Think about the difference between wanting to be healthy and obsessing over the scale every hour. The obsession creates stress and poor behavior. The same applies to trading. Focus on habits, not outcomes. When you stop trying to make money, you start trying to trade well. When you trade well consistently, money becomes a side effect. This is not motivational talk. It is a psychological reality supported by decades of research and real market experience. The market rewards those who can remain calm when others are emotional. It rewards patience, discipline, and acceptance of uncertainty. These qualities cannot coexist with desperation. So if you feel stuck, if you feel like the harder you try, the worse it gets, consider this. Maybe the problem is not your strategy. Maybe the problem is that you are trying too hard to make money. Let go of the need to win. Let go of the pressure to be right. Let go of the obsession with profit. Focus on executing well. Focus on managing risk. Focus on consistency. Paradoxically, this is when trading starts to work. And when it does, it will feel almost boring. That is how you know you are doing it right.